Money Master the Game is a book that comes from Robbins' experiences not only as a child of poverty, but his experiences in investing money he made in his career as a life coach. Although Robbins is not a financial expert, he likes to help people. This book is meant to change the lives of the people who read it, to allow them to stop ignoring the reality that most Americans no longer have substantial savings and will likely not have financial freedom when they reach the age of retirement. Robbins comes to this book not only as a wealthy man who had made a significant amount of money in his career and through investments, but as a man who wants to help by sharing wisdom gained through interviews with the elite 1%ers, people who are super wealthy and continue to make money through their businesses and investments. In this book, Robbins outlines 7 strategies anyone can use to invest their money and achieve financial freedom. Less than 50% of Americans currently have any kind of spending or investment plan. In order to achieve financial freedom, Americans need to invest a portion of their income, preferably 15% or more, in the stock market. However, many people do not trust the financial markets. Others simply believe they do not make enough money to afford any kind of savings, let alone make investments. The first step to financial freedom is shifting from the idea of being a consumer to being an owner. A person must take control of their own financial future by figuring out how much money they can afford to commit to investments. An investor must pick a percentage of their income to invest each week, month, or year, and then automate it so that it is difficult for the investor to forget or stop regular payment into their portfolio. An investor should also make a plan to increase the percentage automatically taken from their pay for investing when they receive a raise at their job. The second step to financial freedom is becoming an insider. To do this, a person must recognize the 9 myths of investing. The first of these myths is that mutual funds or stocks are the best place to put investment capital. However, mutual funds do not always perform as promised, and a single stock can often fall in price, leaving an investor owing money rather than making it. The best place to put investment capital is a S&P 500 index fund that includes a diversified number of stocks rather than just one stock or a mutual fund of similar stocks. The second myth of investing deals with fees. Many mutual funds charge fees that usually come to less than 5% of the investment principal. It does not seem like a large fee, but when an investment depends on long-term compounded interest, a difference in 1% of fees can mean a large hit on the final investment principal. There are also hidden fees in many investments that can add up quickly, reducing the final investment principal or actually cause the investor to lose money. The third myth of investing is that time-weighted funds are not all they seem. In a time-weighted fund, it is assumed that all of the investment capital has been in the fund all year. However, many investors invest a small amount of their income each month, causing the final investment principal to be lower than forecasted when the fund matures. The fourth myth of investing is that investment advisors are essential to smart investing. However, investment advisors are often paid to sell products, not to look after the best interest of their clients. For that reason, many stockbrokers or fund managers are not the ideal people to offer advice to an individual investor. It would be better to seek out a fiduciary who is legally obligated to remove any conflict of interest before advising a client. The fifth myth of investing is that an investor should go with the more popular options when investing a 401k retirement fund. However, this is not always the options with the lowest fees. An investor should do research on their 401k investments to ensure they are invested in the lowest cost index funds. The sixth myth of investing is that target date funds, TDF, a growing trend in mutual funds, is the best way to invest. Unfortunately, most of these TDFs fall over time, leaving the investor with less principal at the maturity of the fund than anticipated. The seventh myth of investing is that all annuities are bad. In reality, it depends on the annuity. Variable annuities tend to have high fees and can be a risky investment. However, fixed annuities based on income often pay off as expected and can be a good investment. The eighth myth of investing is that an investor has to take huge risks in order to achieve huge rewards. This is simply untrue. There are many investments in which the principal is protected, yet the investment still has the potential of a large return in the end. The final myth of investing is based in fear. Many people will not commit to an investment portfolio because they are afraid of what it will mean for their financial security. People must change their attitude toward investing in order to be successful. Once the 9 myths of investing are known and understood, the investor can turn to the third step on the road to financial freedom. This step is recognizing a person's aspirations and breaking them into small, financial goals. An investor should look at the 6 human needs that define the way a person looks at money. These needs include certainty/comfort, uncertainty/variety, significance, love and connection, growth, and contribution. A potential investor needs to identify which of these needs is the primary characteristic that defines their attitude toward money, identify their needs or dreams for the future, and break them into definable steps to financial freedom. An investor should look at their personal income and find ways to invest as much of their income as possible, reduce fees, get better returns, and change their lives with smart investments. Next, the fourth step is to focus on where an investor wants to put their money. Asset allocation is choosing in which stocks, mutual funds, or index funds an investor wants to place their investment capital. Robbins believes that the smart investor chooses a diverse portfolio in which to invest and, by doing so, balance their risk. By deciding how much risk they want to take, and how long they have to reach their goals, an investor can make educated decisions about asset allocation. Asset sustains wealth when done correctly. The fifth step on the road to financial freedom is to make a lifelong plan. The investor has already made a short-term plan that will allow them to create savings and begin investing that savings into something that could, potentially, make it possible for the investor to retire and live a financially stress-free life. However, an investor must also look to the future and secure their wealth for themselves and for their families. An investor should have a diverse portfolio. An investor should have ensured that they will not outlive their retirement savings. Utilizing one of the secrets of the ultra-wealthy, an investor should have investigated private placement life insurance, PPLI. PPLI is a type of investment that allows unlimited deposit amounts, no tax on the growth of the investment, no tax on monies withdrawn, and no tax on any money left to the investor's heirs. Known as the rich man's Roth, this investment is an ideal retirement plan. PPLIs were once only available to wealthy investors, but versions of the plan are now available to smaller investors. Finally, a smart investor will have set up a living trust to protect their family from the drawn-out process of probate. For step 6, Robbins recommends that all investors look to the masters, Warren Buffett's, Mary Callahan Erdos, and John C. Bogle's, to study what they did right both in bull markets and in bear markets. Warren Buffett is known as the most successful investor of the 20th century. Buffett recommends S&P 500 index funds to such a degree that he made $1 million bet with protege partners. Buffett said that protege's top 5 picks of hedge fund managers could not outperform the S&P 500 index within a 10-year period. Buffett is well on his way, after just 6 years, to winning that bet. Mary Callahan Erdos is a rare female executive in the financial world. As Chief Executive Officer, CEO, of asset management at J.P. Morgan Chase, Erdos has made a name for herself not only for increasing their assets by 30%, but as a kind, considerate employer who makes a point of getting to know each of her employees, even those others might consider inconsequential. John C. Bogle is considered one of the top 4 investors of the 20th century, founded the index fund, Vanguard Group, at a time when index funds were still an academic theory. Bogle's has done more for the individual investor than anyone in the history of business. The final step on the road to financial freedom is to take the knowledge this book has imparted, build an investment portfolio that will allow financial freedom, and put that money toward enriching life. Studies have shown that money can buy happiness in 3 areas of a person's life. Money can enrich the personal experience through travel and education. Money can free people from the time-consuming act of working for income and allow far more pleasurable activities, such as the pursuit of hobbies. Finally, money allows a successful investor to invest in other people through charitable works. Knowledge is not power, execution is. The only way the 7 steps in this book will help a potential investor is if they go out and put them into action. Robbins' parting sentiment encouraged the reader to take his words to heart and use them to create a happy, comfortable life for themselves. Main points to remember. Number 1. Investing is a way to make money work for the investor. Investing is essentially putting money to work. Most people know that the best way to make money, other than inheriting it from a wealthy relative, is to work. However, if a person cannot make as much money as they want by working, they need another way of gaining income. Investing can be that way. There are many different ways to invest money. A person could buy stocks, bonds, or mutual funds. Another type of investment is to buy real estate or start a business. These are called investment vehicles. When a person decides to invest, they should investigate each of their options carefully before deciding where they want to put their money. People new to the world of investing might get the impression that investing can be dangerous. Investing is not gambling. When done properly, investing can be a safe method to put money to work in a way that will benefit the investor in the long run. Investing is an important part of modern retirement. In the modern world, most people cannot retire without some sort of investment because the days of steady employment and a reliable pension are gone. In his book, Money, Master the Game. Tony Robbins suggests that everyone can afford to invest even if it is only a small portion of their overall income. This is why he has written this book, to show that investing is not just a wealthy man's game. Even an average person can invest if they know how to do it. Number 2. Compound interest is one of the most important aspects of investing a person will encounter. However, to benefit from compounding, an investor must refrain from removing interest or principal from an investment. Compounding is the process of generating earnings on an asset's reinvested earnings. To work, it requires the reinvestment of earnings and time. When a person places a specific amount of money into an account that earns compound interest, the interest will be added to the balance in the account. If the owner of the account does not remove the interest earned, it will also earn interest as though it were part of the initial investment. Over time, compounding will increase an initial investment, giving an advantage to those who do not touch their interest capital and leave their money for an extended period of time, even if they never add to the initial deposit. If two people decided on the same day to begin saving for their retirement and deposited the same amount of money in an interest-bearing account, they would initially earn the same amount of interest. However, if the first person was younger than the second and left the investment untouched for 20 years while the second was older and only saved for 10 years, the first would end up with more money even if he never added to the original balance. This is because of compounding. Investing maximizes a person's earning potential. Compounding maximizes an investment's earning potential. However, the secret to compounding is that the investor leaves the money and the interest in the account. If a person removes just a little bit of the interest, it will impact the potential earnings of the account in the future because it lowers the potential of the compounding profits. Number 3. To begin outlining a good investment strategy, a person needs to decide how much of their income they can easily invest, and identify how they wish to invest it. Each person who wants to begin investing needs to make a determination of how much of their income they can allocate to investments. There are several determining factors in this decision, but most financial professionals agree on 3 specific factors. The first factor that can help determine how much income a new investor should allocate to investing is the age of the person preparing to invest. A person in their 20s or 30s has more time to make investments designed to provide a comfortable retirement, while a person in their 40s or 50s is closer to retirement age and, therefore, has less time to build a sizable retirement fund. The second factor that will have an impact on how much of their income a new investor should allocate to investment funds is how much disposable income they might have. Disposable income is income above what is necessary for a person, or a household, to survive from month to month. While most financial advisors will tell an investor not to invest the money needed to pay for basic necessities, Robbins suggests that everyone should be able to invest at least 3% of their monthly income, no matter what their income level might be. The third factor that will help determine how much income a person should devote to investing is liquidity. Liquidity is the speed at which a person can convert assets to cash. An investor should know their total liquidity before investing, so that they can understand the fees and penalties associated with accessing money in an investment account, and avoid situations in which they will be impacted by these fees or penalties. Number 4. A person must identify their attitude toward money in order to make informed decisions about their investments. There are 6 human needs that can define a person's attitude toward money. Those are certainty or comfort, uncertainty or variety, significance, love and connection, growth, and contribution. In his book, Money, Master the Game, Tony Robbins states that there are 6 human needs that define a person's attitude toward money. These are comfort, uncertainty, significance, love and connection, growth, and contribution. These attitudes regarding money can influence the way a person deals with their financial situation and how they approach investing. For this reason, it is important for a person to understand their dominant need in regards to money and how that will influence investment decisions. Everyone has a specific attitude toward money, whether it is inherent in a parent's attitude or comes from experience. Some people have a deep-rooted fear that their money will run out. Others have a laissez-faire attitude toward money, assuming that when they run out, more will take its place. Still, others feel that money gives them power or position, and without it, they are no longer the person they truly want to be. Whatever a person's attitude toward money, the attitude has the potential of shaping their decisions when it comes to a basic budget, creating a lifestyle, and investing. If a person is aware of their attitude toward money and takes it into consideration when making these decisions, it can save them a great deal of heartache in the future, as this awareness offers the potential of avoiding potentially catastrophic financial mistakes. Number 5. There are 9 myths regarding investing that a person must recognize and avoid in order to reach financial freedom. These include everything from the myth that an investor needs a broker in order to be successful to an awareness of the numerous fees, both hidden and obvious, that an investor might encounter. In his book, Money Master the Game, Tony Robbins describes 9 myths that an investor should learn and understand in order to become a successful investor. These myths include everything from the false idea that an investor must take risks in order to have the potential of large returns, to the idea that an investor must consult a broker, or have a mutual funds manager, in order to make proper investment decisions. Investing, like almost anything to do with money, requires knowledge. A potential investor needs to understand basic elements of investing, such as what a mutual fund is and whether or not an index fund is a safe place to put investment capital. Every person who has ever invested money will tell a potential investor that there are risks to almost any gamble. However, a person who takes the time to understand what those risks are is a person who will have a better chance of surviving the game without injury. Robbins suggests that if an investor knows and understands the 9 myths of investing, that truth will set their financial future free. Robbins stresses that an investor look for hidden fees, should not assume popular stocks or index funds are the best place for a $401,000 investment, or believe that all annuities are bad. These pieces of advice have the potential of helping an investor achieve the financial freedom they desire. Number 6. Before an investor takes their allocated investment funds and places them into a specific investment account, they must first turn their dreams into achievable financial goals. Investing is about financing a person, or a family's, future. In order to do this, an investor needs to know what they desire to do in the future. They must decide how long they want to continue working. A person needs to know at what age they wish to retire so that they can ensure that they have enough savings to live at least to the age of 67, the average life expectancy in the modern world. Finally, an investor needs to have an idea of how they wish to live out their retirement. If travel is on the agenda, a person should be aware of this in order to set a specific financial goal for the future. In Money Master the Game, Robbins provides worksheets for a potential investor to use in order to determine exactly how much money they can invest, and how much money they will need to be financially free in the future. Once again, it is suggested that knowledge is power as the reader goes over these worksheets and does some real soul searching in order to decide what and how they plan to invest. If an investor knows where they are going, they can better plan the route that will take them there. Number 7. Asset allocation is likely the most important decision an investor will make on the road to financial freedom. Asset allocation is defined as an investment strategy that aims to balance risk and reward by apportioning a portfolio's assets according to an individual's goals, risk tolerance, and investment horizon. Asset allocation will be the most important decision an investor will make because it will determine what an investor's returns will be. Different investments come with different risks and potentials. A person could invest in all mutual funds of a specific type, but not all these mutual funds will act the same way and the results for each will be different. A person could invest in index funds only, but, again, index funds all act differently based on the types of stocks contained within them. An investor should consider carefully where they place their investment capital. Robbins recommends in his book, Money Master the Game, that an investor diversify their portfolio and have a balance of risk and safety that is based on the investor's independent goals. Robbins believes that asset allocation is how an investor stays wealthy. Number 8. After an investor chooses the amount of their income they can invest each month or year, determines their goals for the future, and chooses their asset allocation, an investor should look to the future and define a long-term goal. Investing is all about reaching financial freedom. All the work investors do at the beginning of their investments to reach their goals focuses on the immediate. Once an investor has chosen to invest, and how to invest, they should look toward the future and decide what the next step should be. An investor should focus on diversifying their investments in order to be prepared for changes in the market by using tools that can show what the returns of current investments will be in the future. Then an investor should make sure that their investments will guarantee they will not outlive their savings. Finally, an investor should invest in the future of their family by setting up a living trust that will protect their family should the worst happen. A living trust will ensure that family will not have to go through the process of probate, a legal process that can leave a family without assets for an extended amount of time. In all things, a person should look to the future and prepare for what is coming. Although life is often unpredictable, there are norms that can be planned for. Most Americans know they will retire one day. They know that, if they have family, that it is more likely than not that children will outlive them. To take responsibility for a person's financial future often requires a person to look not only to their own future, but to what will happen to family left behind when the investor dies. When the investments are made and an investor is looking forward to retirement, that is the time to also take care of other responsibilities that will ensure not only a happy retirement, but the security of their family too. Number 9. The 0.01% are a group of people whose personal net worth is more than $100 million. This group includes Warren Buffett, the most successful investor of the 20th century. Step 6 on the road to financial freedom is to learn from this group of people and attempt to emulate what they do in both a bull and a bear market. In preparation to write his book, Money Master the Game, Tony Robbins interviewed a handful of successful investors, including a select number of 0.01%. These people are personally worth more than $100 million, due in part to their ability to read the market and make successful investments. Robbins' advice to new investors is to study these 0.01% and learn from their actions within the stock market. Even those who are most educated in investing can lose money with their personal investments. However, it often seems that there are a few people who never fail. They make investments that almost always have high returns. These people seem to know some secret that makes it possible for everything they touch to turn to gold. For this reason, it is wise advice for a new investor to study the actions of these elite investors and to attempt to not only learn from them, but to repeat them even if it is on a smaller scale.